intangible assets have a finite life, we lead to two things. One is amortize the value for each year, and also review the impairment annually. And here we have some factors to say why the intangible assets have a finite life. Usually it's because of legal requirement. For example, the medicine patent usually only has 20 years usage. So when I was a CFO in a pharmaceutical company, we have a team to observe some patents due date, because, for example, one patent will be due on today, 12 p.m., or tomorrow, 12 p.m. The team will submit the application to use the innovation after the due date, maybe, 1 o'clock. So it needs some time to apply this competitive usage after the useful life due. So that means some intangible assets will have finite life, but some business sequence, like the Coca-Cola recipe, it's in the infinite life, because they just hide this kind of innovation, and then it can keep this intangible assets forever. Okay, so the example is when we build the intangible assets, we need to measure, to recognize its cost, and then when we use this intangible assets, we will amortize the value for each year. So in this case, the Schultz company bought the patent for $85,000, and the usage period only 10 years. So we use the straight line method. Each year we will use $80,500 of this patent. So when we purchased this patent, debit patent, $85,000, created a cash $85,000. And then after we used it for 1 year, we need to amortize the cost, debit amortization expense. The amortization expense is like a depreciation of fixed assets. So it will, it's a contra asset account, and created a patent. That means the value of the patent will decrease $80,500. So after that, after the first year, the book value will become $76,500. Okay, that's easy. And then for the intangible assets with the finite life, we need to do impairment review, as I just introduced, because intangible assets are measured as with the fair value, and the fair value may be decreased and lower than the book value. In that situation, we need to recognize this impairment. So we have two steps. The first step is a recoverability test to see whether the carry value, the carry value is total undiscounted cash flows expected to result from the usage of intangible assets. Whether this expected value less than the book value. If so, we need to measurement this loss. Say this is the market value, the total undiscounted cash flows. So say if I have the patent, the book value is $8,000, but the market value is only $6,000. Then I need to measure this $2,000 loss. So we have an example. Here is because of technological development, Shell's company decides to review its patent. The book value is $68,000, and the fair value is $25,000. Okay, so in this case, don't be confused by the Shell's estimation. The recoverability test use the market value and the book value. So because the expected future cash flows are less than the book value, then Shell recognize this impairment is $68,000 minus $25,000. So debit loss on impairment created a patent. And then the book value will decrease to $25,000. Okay? But remember, after you recognize this impairment, if in the following year, the fair value increased to, say, $68,000 again, you cannot restore the value. Why? It's because conservatism principle. If the GAAP or the SEC allow this kind of behavior happen, management will take advantage of this opportunity to manage earnings. Say this year I want the earnings a little bit low, then I recognize the impairment. And the next year I say the value increased and I restore the value, and I will get gains. That's not legal. So after you recognize the impairment, you cannot restore the value again. Remember that. Okay. And then if the intangible assets with an indefinite life, we only need to review the impairment. So the example shows you loading company purchased the trademark 2 years ago for $60,000. And then the loading determines the fair value is only $20,000. That means we needed to record the impairment loss. Remember, this is the video, so I will explain something very fast. You need to read the contents in the textbook slowly and digest this kind of thing. Okay? So in this case, debit loss on impairment, $40,000, created a trademark, $40,000. And then intangible assets with an indefinite life. We need to review the impairment. And the impairment loss is a component of income from continuing operation on the income statement. And the fair value is reported as intangible assets on the balance sheet. So we need, for example, for goodwill. Goodwill is defined and measured as the exercise of the purchase price of the fair value of the acquired company's identifiable net assets. So let's see. We have the same example, similar example. Here is a patent, and the goodwill is same as this, as in this case. For example, I bought Starbucks for $15 billion, and the book value at that time only $10 billion, and then $5 billion goodwill. And after 1 year, if the fair value only $14 billion, then the goodwill, the $5 billion goodwill will decrease decreased to $4 billion. So it's easy to recognize and measure this. And then we will have a discussion about research and development cost. So we have the research is different from development. Research is just to discover new knowledge. And development is we can translate the knowledge into products. Usually, we can have a prototype. For example, I research an algorithm to make money from the stock market. That's research. After I get the result and develop a prototype to arbitrage stock market, then that's development. So GAAP requires that a company expenses all of its research development costs as incurred. All of the research and development costs as incurred. So it's directly going to income statement as expenses. It's unnecessary. You cannot capitalize the R&D as an intangible asset. And they will have some examples about what is R&D, say laboratory research and discovery of new knowledge, and what is not. The example in like a quality control, that's just routine testing of products. It's not R&D. Okay. And then, so for research and development costs, we directly go into R&D expense, and it will include materials, salary for the personnel, and or other intangible assets or other services, and so on and so forth. It's about the materials, about salaries, and all of these related expenses. So this is an example of R&D measurement and accounting treatment. So can the company spend the following costs for the R&D activities? Materials, $50,000, and also salaries, $19,000, and other administration expense, and also depreciation for buildings. Altogether is $215,000. So we can use the journalization, say, debit research and development expense, credited cash, inventory, and accumulated depreciation. It's like some other expenses recognition. So that's easy, right? And then this is another example. Say this can the company include and paid the following costs for R&D? So debit research and development expense, credited cash, inventory, accumulated depreciation for building and also for machine. That's for R&D. So in general, for R&D, it's unnecessary to capitalize it. It's just go directly into research and development expense to match the revenue at that time, at that period. But one special case is in-process R&D. And the special is when a company that is performing R&D activity and was purchased by another company. So at that time, this R&D is a kind of intangible assets. So it's called in-process R&D. And at this time, remember two procedures. Number one, initially capitalized as in-process R&D. It's IRP&D. This is an intangible asset. And then we will deal with these assets depends on what's the result of this project. So in-process R&D is expensed immediately if the project is abandoned. That means no result. Otherwise, accounted as a finite life or an indefinite life asset. So it depends on this, the nature, depends on the result. Okay? And here we'll have a startup cost. This is a kind of intangible asset. So startup costs are the costs incurred for one-time activity related to opening a new facility or a new operation or introducing a new product. So all of these startup costs include organization cost, legal fees, certificate costs, and accounting fees with forming a new company. So the accounting treatment is GAAP requires starting up costs as expense. It's like R&D, like the R&D expense. Okay. See you in another video.